Good evening, everyone. I'm sure you're all keeping safe, doing good in the midst of a lot of practice, a lot of studies going on. I can see a lot of students' greetings already. So, good evening, all of you. Jaspreet, Jash, Piyush, Geet, Priyanka, Manoj, Janesh, everyone, Sapna, and Alok. So, great, guys. So, I'm sure you guys got some chance to kind of catch up with what we studied in the last session on Tuesday on investment decisions. A quick recap, we talked about some significance of capital budgeting. We also talked about the methods to evaluate the investment decisions in terms of the non-discounting techniques and the discounted techniques. We specifically focused on NPV and IRR. We also talked about that, how there could be scenarios where NPV or IRR could be giving conflicting decisions. We also talked about a very special method called modified internal rate of return, MIRR. Now, we need to continue from where we left. And I'm sure you guys had a chance to practice some questions on calculation of IRR and NPV. But today we'll be talking about some specific cases where we will be having the application of the same, right? So as you can see on the screen, what if we are looking of a scenario where we have a limited capital, which generally the case is, right? So in this case, if my capital is limited, I would rather be focusing on whatever projects I can do within that capital, within those funds, which have positive NPV. I think that makes sense to everyone, right? See, because that aligns with our objective of wealth maximization. However, if my capital is limited, we might not be in a position to select all the projects with positive NPV. Now, this is something which we just touched base upon Tuesday, that when I said that there could be a scenario where we have limited funds, we have to select more than one project. Can we always go ahead with the project with the highest NPV? May not be the case. We may have to select a combination which can utilize all the funds and give a maximum combined NPV, guys. So Dinesh, we're just now starting to discuss that, right? So what I'm trying to say is that where my capital is constrained or a limited, guys, we may not be able to do all the projects with a positive NPV. We have to select only some projects. And the idea is that we are targeting at a combined NPV as maximum. It may be a scenario if we select the project with the highest NPV, we are not able to select the second rank project. We are selecting first and third, which is not giving us a maximum NPV as compared with kind of something combined with second, third, and fourth. Depending on the combination, the investment required in the funds. So we'll talk about with the help of an example for the same. Now, when the capital is limited though, it also depends on whether my project can be completed or accepted entirely, or is there any possible that scope where you can probably accept that project in past, guys, kind of in part. What I mean is, let's say there is a project in which there are different aspects, different elements, and you can actually select part of the project. That is generally possible when the project is divisible, guys. You may wonder that, practically how the hell that can be possible. No, there could be a scenario where different fields of specialization are involved. And let's say we talk about a construction contract and we are probably focusing only on the structure. We are not focusing on the finishing aspect, right? So it really depends on if my project is divisible in nature or not. The decision to invest and the combinations of the projects which I will select will actually depend on this fact whether my project is divisible or not divisible. If it is not divisible, guys, that means either the entire project will be selected or rejected, then we have to rank those projects on the basis of absolute NPV. And we need to kind of select that combination which will give us maximum possible NPV. And to ensure that maximum resources are exhausted, if not all. However, the interesting aspect is, if my project is actually divisible in nature, then it could be possible that we could actually invest every penny. We might be able to select part of the project. So whatever funds are with us, we can select that part as well. In that case, the ranking will not be basis the absolute NPV, but ranking will be based on NPV per rupee of capital invested, guys. I'm sure some of you may not able to understand this easily. So let's talk about this situation with the help of an example here. So at the bottom, you can see an illustration. Parvati Limited is planning its capital investment program for next year. And it has 5 projects, all having a positive NPV with a company cutoff rate of 15%. Investment outflows and present values are given to us in thousands. And company is limited to a capital spending of 120, guys, 1,20,000. That means we fell under the scenario where my capital is limited, guys, which generally would be the case. It's more of a capital rationing case. So let's see what are the projects here. We have project A, B, C, D, E. We have investments given to us in thousands, 50,000, 40,000, 25, 30, 35. If you add them all, how much you are getting, guys? If you add the investment in all the projects, I think 180,000, if I'm not wrong. But do we have 1,80,000? I don't think so. We have 1,20,000. What we need to do is, what could be the package of the projects that we could do here, assuming whether my projects are divisible or non-divisible, guys. Now, we will talk about both the scenarios. First, let's talk about that the projects are independent of each other and are divisible. That means part project is possible. That's the first discussion we are talking about. So, part project is possible, okay? We are given investment. We are also given NPV for every project, guys. Now, if the project is divisible, I would actually go to ranking the projects based on NPV per 1 rupee invested, guys. So what is NPV per 1 rupee invested for capital for the project A? 15.4 divided by 50, 0.31. For B, it's 0.47, and so on. But if I can see, project E is giving you the maximum return per rupee 1 of capital invested. And accordingly, we can rank these projects. So project E is number 1, B is number 2, and C is number 3. Mind you, the projects are divisible. If the projects are divisible, we are utilizing the entire 1,20,000. Okay, so let's see, we go with this rank. Right? If we go with this rank, my first target would be project E, which has 35,000. How much I am left with, guys, out of 1,25,000? So this is, let's say, remaining. Remaining is 85. My second rank is project B, right? If that is the case, we are looking at another 40,000. We are now left with how much funds, guys? Anyone? Let's see your responses. How much funds we are left with? We are left with 45,000. I hope everyone is able to understand this, responding to the questions I'm asking. Someone said 35, someone said 30. Guys, can you just double check? E requires 35, B requires 40. So after 75,000, I think 45,000 should be left, right? Can you just please double check here? Getting different responses from students here. Want to double check? Okay. Once we are done with project E and B, we go to the third rank. So we have taken E, We have taken B. We go to the third rank, that is C, guys. C requires a capital investment of 25,000. Now we are left with 20,000 only. And there are two projects which are left, A and D. Which project should I go from here, guys? That means E, B, and C can be taken. E, B, and C can be taken, but what should be my next point of selection? A and D, A or D? Mind you, the part of the project is acceptable here. Divisible, right? So next in line is with project D with a ranking of 4, guys, 0.37. Now, the only problem I have with project D, it requires an investment of 30,000, whereas I am left only 20,000, guys. So can we say with 20,000, we can select 2/3 project of D? Can we say that? Because projects are divisible, we can say, okay, 2/3 of D. So my answer would be, I would be investing in projects B, C, 2/3 of D and E. Right, Geet? Alok, Ganesh, absolutely. Josh, good. So I think now everyone is with me, Prachi and all. Yep. Okay. So guys, this is the case where the projects are divisible. What if my projects are not divisible? I said, if the projects are not divisible, then you're talking about ranking as per the absolute NPV. And then you can just select that combination which is giving a maximum NPV here. So if the projects are not divisible, then we select NPV ranking. So what is the highest NPV? It's coincidentally again project A, E. Second is again it is B, it seems. But I think third ranking is different here, right? Third ranking, otherwise it was C in the earlier case, but now I can see it's A here. So first 2, 3. Okay, so Phil, we will talk about that also. Whatever the opportunity cost given, we might be taking. But in this case, let's not worry about that. Okay, so if we go with the absolute, NPVs, what could be my combination? So if we select option E, our NPV is 19.3. We select also option number B, our NPV is 18.7. And if we go for E, A also, we will get a 15.4. But the question is, can we actually go for E, B, and A? That is the question. Probably, if you see, E requires 35, B requires 40. We are anyways left with only 45,000 guys. That means we don't have funds for A actually. We have funds for C and we have funds for D. My fourth project is D here, which gives me 11.2 as an NPV. So I'm taking 35,000. I'm taking a 40,000. I'm taking another 30,000. Guys, getting it? That means I'm actually investing only 1,05,000. Okay. Just as a question, sir, I don't get it. Why should you take absolute NPV here? Okay. Just because you are not investing every single penny. And also the fact you will be seeing the combination which will give you the maximum NPV. So one combination I've just discussed. One combination is where you are investing 1,05,000 and you are getting how much? 49.20. One is this combination. Other combination could have been E, B, and C. But NPV would have gone down. Okay. You can think of any other combination also, guys. Can anyone try A, B, and D? Can anyone try A, B, and D, guys? A, B, and D. Amazing, right? Entire 1,20,000. Entire 1,20,000 will be invested if you invest in A, B, and D. But A has a NPV of 15.4. B has 18.7. And D has 11.2. So let's see what is the total NPV here. 45.3. So utilizing the entire 1,20,000, you are getting only 45.3 NPV, whereas in E, B, and D, where you invest only 1,05,000, you're getting 49.2 as NPV, guys. Which combination will you select? Will you go for EBD or you will go for ABD? What do you think, guys? I think I would go with the EBD, right? A, we are not even exhausting everything and we're getting a maximum NPV, and then there could be another opportunity for the remaining 15,000 somewhere else. So just that will anyways increase your benefit, right? I think your question itself has the answer. Like just now I said, in the EBD combination, you are left with 15,000, right? You could invest somewhere else also. Just don't forget, our basic premise or the assumption here is that we are not dividing the project. Project is not divisible here. I think basic premise is that, and then it should make you clear. Great, guys. So I hope everyone is clear on this. Great. So good start to the evening. We talk about a very, very interesting illustration where we are looking at a capital rationing scenario. Now, let's see what's happening here. A kind of question for everyone, guys. So this question is talking about 4 projects with the NPV, and we have to require optimize the returns. And they're saying that there are a couple of scenarios. One, project are independent and divisible, and the scenario projects are not divisible also. You're most welcome, Josh. So, guys, I want you guys to answer here. You want to give me the answer for point number A first, where the projects are divisible. What should be your scenario? Can we first do the ranking here? NPV ranking is a straightforward one. NPV is given to us. Project B has a maximum NPV. And then we have C, A, and D. So B, C, A, D. Then we calculate NPV per rupee 1, which is 0.5, 0.35, 0.48, and 0.30. Ranking will change. Now project A is number 1, ACBD. So your ranking is in front of you. You need to tell me the projects you want to take for question number A, guys. Projects are divisible. Which projects you want me to take? Waiting for your answers. Mind you, you need to remember that ranking is for the NPV per rupee 1 is A as rank number 1, right? I got answers from Josh and Alok already. Okay, so if we look at divisible projects, it seems A will involve a 40,000. Then second rank is C, will involve 50,000. And the third rank is B actually, right? If I'm not wrong, third rank is B. So B would be, we are only left with 10,000 here because we total have a 1 lakh. So we just can be talking about a 10K invested in B. That means 1/10 of the project. 1/10 of B. All okay, guys, till now? Or we can say 10% of the project. Okay, what could be the scenario when the projects are not divisible? What would be the scenario when the projects are not divisible? If they're not divisible, let us see what are the combinations we have. Okay, we invest. Okay, project B is number 1, right? So if we invest entire amount in project B, we are getting a 35K of NPV. But if we don't do that, if you only go for second and third project, guys, instead second and third project, that is C and A, which will be giving us a 24,000 and 20,000. Classic example. Manoj, you said, I think you need to just double check. I think if we select only B, we are looking at 35K NPV. But if I look at C and A, as a combine, I'm getting 44,000, guys. Anyone want to check? Any other combination you want to suggest? I'm pretty open to listen. It seems project A and C is a good option here. Okay, great. So I think whatever answers I've got, I think it's kind of matching with what our thought process is. So Manoj, Dinesh, Jyoti, Alok, Prachi, kind of almost Vishwaja, everything, I think going as per the track. Great. Good, guys. So good job. I think we all agree on to our answers with each other. Consensus is there finally. So let's move on to another scenario. Remember when we ended the session, I talked about a scenario where NPV and IRR were giving yes, Sofal. So we were talking about a scenario of conflicting decisions between NPV and IRR where the projects were of unequal lives. And we said that, probably there we might have a solution called equivalent annualized criterion, or also called as replacement chain method, where the project with a smaller life can be repeated once or twice more. The only thing is the smaller life project should be in the multiple, or it could be in exact multiples of the larger life, right? So when we are looking at the scenario, let's talk about these methods. So the point we are discussing here is where the projects are having unequal lives. So then the problem is that should we retain an old asset, replace it with new one, or how do we select one proposal amongst the two? Now, what is the replacement chain method? Now, replacement chain is a method which repeats the shorter projects multiple times until they reach the lifetime of the longest project. And that's why I said it has to be in the exact multiples. Size of the one project is in multiple, like double or triple of the other, so that in repetition, the size can be equalized. We are not repeating both the projects. Someone may say that, sir, okay, if one project is 4 years, another project is 3 years, we can repeat one project 3 times, another project 4 times and make it 12 years. No, we are not calculating LCM here. Okay, so we are just saying that, okay, smaller project can be repeated once, twice, thrice, so that it can be equivalent to the, the larger size project. So that means it's very important that in that case, since both the projects will be of equal lives, and what will be my conclusion, guys? Project with the highest revised NPV can be selected. So which method is preferred? You guys were asking me on Tuesday. I said NPV would be preferred, right? Now, because the projects become equal in life, the fact with IRR favoring a smaller life project is gone now. Both projects are equal life because the smaller project is repeated. Right? Now, what is equivalent annualized criteria? Now, equivalent analyze criteria is where we divide the NPV of the projects with the unequal lives by their respective present value annuity factor. We discussed on Tuesday what is PVAF. Present value annuity factor is sum total of individual present value factor for multiple years. So we divide the NPV by the PVAF, present value annuity factor. Then it will give us the equivalent annualized criteria, and the project with the highest value can be selected. We need to know the names and what exactly we do in these two methods, and we'll also look at the example here, right? So let's see. So Dhoom PLC. Okay, there is a question coming in from Pranav. The project is divisible, then project which we are not in multiple can also be chosen. Okay, Pranav, we are now we are discussing something other than the capital rationing. We are not talking about capital rationing here. We are just talking about where the projects have unequal lives, the contradiction between NPV and IRR. So we are saying that projects which are not in multiple can also be chosen. So see again. So don't mix the two things. There we are talking about divisible or not when we are talking about capital rationing. This is a different discussion altogether. Okay, Prachi, in that case, Prachi says if one project is for 3, other is for 4, we cannot apply this criteria of replacement chain. Then we will have to go for an equivalent analyzed criteria, Prachi. Make sense? Okay. So Dhoom PLC is considering modernizing its production facilities. It has 2 proposals under consideration. Expected cash flows associated with these projects and their NPV with a 12% discounting rate are as follows. And the question is, of course, which project can be accepted? So if you see project A and B, guys, do you see a situation here? It says in replacement chain method, if we revise IRR, will IRR change? In replacement chain method, you mean to say, Prachi, that, Geet, that we are talking about calculation of IRR in the repetition stage. Even if you revise it, it will come out to say. Okay. I hope, Prachi, that's what you want. Geet, sorry, you wanted to ask that, right? So I think this was Geet's query, not Prachi's. Okay. So you can see the example on the screen now, guys, that project A is of 6 years, project B is of 3 years here. When I say project A is of 6 years, project B is of 3 years, and you can see that there is a contradiction in the result. A shorter life project is preferred by IRR 25.2 higher than the 17%, whereas in the project A, it is preferred by NPV. Now, what we have done is we have taken another scenario that what if we repeat the project B twice? I know you guys can challenge it by saying that whether there will be in practical life a similar project waiting for us after 3 years, right? But this is just for a decision point, right? When we are doing some estimations, we can see this, how it will be after the 3 years if there is a similar project. So we are repeating project B. So also, Geet, why the IRR will be same? Because you look at this now, this trend is same. You're doing project B once, and then you are doing project B again. So in the 3rd year, project B is completing and also again starting. So with that process, my NPV is increased to 882 for project B. My NPV is increased. And then because of this method, in terms of the replacement chain, my both NPV and IRR are giving similar results. They both are telling, okay, except project B, guys. There is no contradiction now anymore. Everyone okay, guys? I hope this is clear to all of you. So with the replacement chain, there is a consensus in the decision that is project B is selected here. Can I get a confirmation here, guys, from everyone? All doing okay till this point? Any questions? Getting the jinx of it? Okay. Now, so the Prachi's question, what if the projects were not divisible? So Prachi, if the projects could not be repeated, which is also given at the bottom, if the projects couldn't be repeated, if their lives are not in multiples, we will use equivalent annualized criterion, right? So we divide the NPV by the present value annuity factor. Present value annuity factor is different for A and B because of the different lives. A is for 6 years, B is for 3 years. And we then also decide project B because we have a larger number here. Project B gives a largest equivalent annualized criterion. Geet says, Geet, exactly this is what I said. Now we are not doing that. Geet says that I have an idea that why don't we take them to a common multiple like 12. Geet, we are not doing that. If it is 4 and 3, do equivalent annualized criteria. If one project is in the multiple of the other, that can be repeated, but we are not repeating multiple projects here. Probably it may give you the same result, but you are just increasing the work, right? I think this is another way to look at it. Okay, Sufal says, if the same projects are being taken consequently, are we assuming the same initial investment again? Yes. So Sufal, I already told you that practically, from an assumption standpoint, this method can be challenged. I told you anyhow. That practically, will you get the same project again? Very unlikely. Theoretically, yes, we need to know that, okay, since we are deciding, guys, okay, we are deciding, we are comparing apple to oranges. We are just somehow visualizing that how an orange can look like apple, right? I'm not confusing you guys, but the idea is that, orange is still orange, but we are just kind of visualizing it as a different fruit so that we can compare apple to apple. Practically, you are absolutely right. I told you very much in the beginning that, there could be a scenario that after 3 years, you may not get a project B again. But if we had look from a perspective of today, right? Today I have to compare project A and project B. What kind of an assumptions I can take? All the financial models are based on one or the other assumption anyways. Sufal, I hope that makes sense. See, again, and that's why we have equal, I would actually go with the equivalent analyzed criterion because whatever the life is, it is give us a true return, right? In terms of the time value of money. So Vishwaja is asking, are we discounting again from year one? Okay. Vishwaja, we are not discounting here in equivalent annualized criteria. We are dividing the NPV by the present value annuity factor. We are just dividing it just by calculating what is my annualized value in terms of the time value of money. Whichever project is giving me the maximum number, I am selecting that. That's project B. Great. Good. Great, guys. Thanks a lot. So Alok, Sufal, and I hope Prachi, Gee, Jyoti, you guys are doing good. Sapna, everyone else, Dinesh, I'm sure all of you are doing good till now. We move on to another very, very important aspect, and I request you guys to be just kind of pretty much awake and be attentive as you always be. This is a very, very important section in terms of capital budgeting, where you may have a pretty interesting question coming in your path in the examination, which requires a decision with respect to replacement of machinery, guys. Now, what is the decision in front of you? We have an existing machinery. One option is that operations can continue using that, or probably over the period of time, a lot of machineries come with the latest models. I know what it's kind of very, very practical scenario, right? Forget about your machinery. You talk about your mobile phones, right? I'm sure many of you feel to upgrade your mobiles after 3 years, 4 years, or whatever, right? And when you go to a shop, right? So let's say a mobile is for 20,000 bucks. What do you do the shopkeeper, right? You negotiate. You negotiate. The shopkeeper says 20,000. You said 19,000. Shopkeeper says, take it. What will you feel, guys? If in that case, the shopkeeper is agreeing very easily from 20 to 19, you guys will be saying, oh gosh, I could have bargained more, right? He agreed on so easily. So we are never happy either way. But anyway, so just kind of a lighter example that, okay, we even it comes to the personal gadget, we tend to upgrade it over the number of years. Then why not machinery? Why not in property, plant, and equipment in terms of the projects? So it could be a scenario where a manufacturing company is there. They have been using an asset for over the years, and due to the technology, due to the utility, due to the requirements, you might think of replacing that machinery with a newer version which might have some additional features, or a completely different model also. That could be possibility. Now, what are the factors you need to consider? Remember my discussion on Tuesday on this. We were talking about a scenario where he might go for some relevant cash flow, right? Dinesh says that I should have said 18,000 to the shopkeeper. Dinesh, I should have started with 15, right? Once you guys are qualified CA, you will start with 15. And the shopkeeper will start reducing from 20. You guys may meet somewhere around 18, 18.5, right? Anyway, so coming back, so I think we can come back to the machinery. So Geet says incremental. Absolutely perfect, Geet. So guys, we discussed on Tuesday that we talk about the relevant, anything which is changing, right? So what changes? Let's talk about this. Cost of the new machine will be some additional item. Now, the existing machine will be either sold or there will be an exchange happening. You will also compare the existing cash flows and the new cash flows. So operating cash flows from existing and new machine, salvage value of the new machine, what you will get at the end, tax impact. Now, remember that we talk about the tax impact on gain or loss in terms of keeping the block of assets in mind. So you can see, just for your reference, guys, there are steps mentioned herein. You have a step 1 where you have a net cash outflow, wherein you talk about book value of the old equipment minus market value of the old equipment. What is that? This is basically from a perspective of the sale, book value of the old equipment minus market value, right? So whatever the gain or loss, so that is the cash outflow is one part. Then we're also talking about cost of new equipment, right? That cost of new equipment can be probably adjusted with the whatever the sale value of the existing equipment and any tax saving or payment. So first point is talking about the word net cash outflow. Net means the new after adjusting the sale of old and tax implications. Step 2 is estimate the change in cash flow per year if replacement decision is implemented. Now, what is the change in cash flows? Of course, there could be either increased revenue or reduced cost. Right? Change in sales, change in operating costs, change in depreciation could be the case, because depreciation change will change the depreciation tax shield also. That could be another scenario you need to know. So we have calculated change in the cash outflow, net cash outflow, change in the cash inflow per year. And then we can calculate the present value of the benefits. That means present value of what we have calculated under stage 2. And we can compare that present value with a net cash outflow, initial outflow. Simple. So simple fact is we still maintain our scenario of a decision based on the relevant cash flows. If my present value of increased benefits is more than the present value of the cost, I will accept it, else I will continue with the same machine. The concept wise it's same. There is no new concept, guys, here. However, the practical challenge could be where you apply this thought process into a question, into a scenario, into a case study, you might miss a point or two. So let's do this. Let's target to kind of look at this particular question slowly. I want everyone to understand for 3 years. Machine has been, remaining estimated useful life of 5 years with no salvage value in hand. Its current market value is 2 lakhs, guys. company is considering a proposal to purchase a new model of machine to replace the existing machine. They're giving you a lot of information here. Existing versus new. Existing machine cost, new machine cost, life. Existing machine is 8 years, but mind you, I think on the top they've said remaining estimated useful life is 5 years, guys. Remaining estimated useful life is 5 years. So probably remaining life for the existing machine is 5 years, and the new machine itself is also with 5 years. Salvage value for the new machine is also given. Old machine, they've given the current market value of 2 lakhs if you were to sell it. Annual output gets increased, guys. Look at this. Incremental, remember, 30,000 to 75,000. Selling price remains the same. Annual operating hours same. Labor cost kind of slightly increases, 40 to 70 per hour. Indirect cash cost per annum is also increasing from 50 to 65. Now the company uses written down value of depreciation, and it has several other blocks, machines in the block of assets. So that means you are following the block of assets. And what is the fundamental of block, guys? Because you have several other machines, we'll be ignoring any gain or loss, right? Because gain or loss happens in the block when it is the last asset. Income tax rate is 30%, and you do not make any investment which yields less than 12%. So what is 12%, guys? Your WACC, cost of capital. So that is a discounting factor for which the PV is given to us. Right? So what is the question we need to have? We are the advisors for Zavli Limited, whether this existing machine should be replaced or not. Okay, guys, I want some input from you guys. What will be my net initial cash outflow? Net initial cash outflow, considering there is no gain or loss, right? It's a block of assets. Who will tell me the net initial cash outflow? Just waiting for your responses. Jyoti, Alok, everyone says 10 lakhs. Guys, just to tell you or remind you, when we're saying net initial cash outflow, concentrate on the word net. If you are purchasing a new machine, are you selling the existing machine also? So probably my net initial cash outflow, net initial investment seems to be 10 lakhs minus 2 lakhs, right? Alok says 1065, Sufal says 961. Guys, I hope you guys are not considering gain or loss or taxability there. It's a block of assets, right? There are other machines in the block of assets, so no gain or loss here. So the net investment at 8 lakh then? 10 minus 2. So Geet said 8 lakhs, Jyoti said 8 lakhs, Pranav also. Great. Those of you gave me different answers. Are you with me now? 8 lakhs? Okay. What's going to change further is the depreciation and also the profitability. The profitability will also change. So let's go ahead with these one by one. Let's together go through this. Give me 1 second. Okay. So guys, we are all okay with the initial cash outflows of 8 lakhs here. Now, let us target about what is the change in the cash outflows, calculation of annual profit before tax and depreciation, and also understand what will be the change in the depreciation, guys. Now, existing machine cost is 3,30,000 here. That's what given to us in the question. And mind you, depreciation was what? That is a written down value of a 20%, guys. So that means every year the depreciation will be on the written down value. 330 minus 66. 330,000 minus 20%. And then you talk about into 20%, you get 52,800. This is on WDV. So my total WDV of the existing machine is 1,68,960. Now, because it is a block of assets, what's happening is he's saying that the cost of the new machine is 10 lakhs. WDV of the existing machine is 168. We are selling it for 2 lakhs. Hence, depreciation base of new machine is 9,68,960. However, we need to understand what was the WDV of the existing machine, guys? 168. Because we are not calculating any gain or loss, my new depreciable base is 9,68,000 and my existing base was 1,68,000. What is the difference between the two, guys? 9,68,000 minus 1,68,000, 8 lakhs. That means the incremental depreciation will be on 8 lakhs only. Everyone with me on this? Incremental depreciation will be on 8 lakhs. How this 8 lakh is calculated is 9,68,960 minus 1,68,960. I want everyone to understand this, please. This is important. Let me know if there are any doubts. Okay. Geet says WDV of existing machinery is opportunity cost. Geet, I think I would restate it in a way that what has changed, right? You guys should just focus on what is changing, right? If this was not happening, you would have charged the depreciation on 168,960. Geet, Pranav, I think you also. If nothing was happening, guys, if nothing was happening, your depreciation would have been 1,68,000. Am I correct? 168,960. If nothing was happening. And if we are changing the machine, you will be charging depreciation on 9,68,960 because there is no gain or loss, block of assets. Sapna says, why depreciation for 3 years? Sapna, the asset estimated life is 8 years. If you see the second line of the question, remaining estimated useful life was 5 years. That means the asset is used for 3 years. So guys, everyone got it? Pranav, Geet, Jyoti, Prachi, everyone? That if nothing was done, it was 168. Since we are replacing it, it's 968. What is changing is extra depreciation on 8 lakhs. One can argue that, sir, why can't we take that 8 lakhs directly from the initial outflow? I think shortcuts may be dangerous at times. So it's better that you compare it by calculating the depreciable base in the existing scenario and in the new scenario. Want a quick confirmation? Everyone doing okay right now? Great. Okay, now let's move to the right hand side here. We are now moving on to what is changing in terms of the revenue and the cost, right? As you said, that my entire focus is on in this big triangle. What is changing? What's the delta here? What's the delta? So delta is your differential. We are talking about 30,000 and 75,000 units has increased by 45. Thankfully, the revenue has not changed. So my incremental revenue is the difference between the two, 6,75,000. Material cost also remains same. But since the total number of units increased, so additional units, 45,000 into 4, 180. Now labor is changing, guys. Labor initially it was a 40 per hour. which was 3,000 into 40, and now it is 70. So 3,000 into 70. So additional labor is 90,000 here. Additional labor of 90,000. Even the additional indirect cost of 15,000 also. So my total cost is 180 plus 90 plus 15, 285. If we compare with an additional revenue of 675, I'm getting a profit before tax and depreciation of 3,90,000. This is additional, I would say. Differential, relevant, whatever term you want to use. Everyone with okay with 390? And may I know what are the next steps then? If we all agree that 390 is the additional number, why we get the additional number as 390? My additional revenue is 675. My additional cost is material 180, labor 90, and indirect cash cost 15,000. So total is 285. 675 minus 285 is 390. Now, if it is a profit before tax and depreciation, what should we do, guys, next? Dinesh says, why are we taking difference? Dinesh, till now, what have we done? Till now, see, my answer to that question, Dinesh, is at every stage where we are talking about replacement, we are talking about differential. If the differential at the end of the day, the present value of the differential things are positive, we accept it, else we reject it. Because see, the initial cash outflow was net, right? 8 lakhs was additional. The basis for depreciation was incremental basis, 8 lakhs. So Dinesh, everything is based on what is going to change. Please be aware of that. Now, if we get 3,90,000 for all the years, 5 years. So we have seen 390 here. Now the problem is the depreciation was a WDV. WDV, right? So 8 lakhs minus 20%, 1,60,000, 640. Again minus 1,20,000, 28,000, sorry. We get a 4,12,000, I guess. 4,12,000 into 20. I think it should be 5,12,000, right? Not 4 lakhs. So 5,12,000 into 20%. We're getting 1,02,400 and so on. So we calculate these WDV depreciation 160, 128, 1,02,000, 81, 65 because we have to add back this depreciation later on, kind of in terms of the tax sheet. So profit before tax is after reducing this depreciation. We are all at this column, 230, 262, and so on. Mind you, the number is increasing because the depreciation is, of course, reducing. Then we have a tax. But I want you guys, all eyes on, after calculating the tax, all eyes on the next column, guys. In the next column, we are seeing net cash flow, but look at the formulas. It's equal to 4 minus 5 plus 3. That means we are looking at a profit before tax minus tax, adding back depreciation, guys. I hope everyone is okay here. We are adding back the depreciation. Minus 69,000 plus 160. It's 321. And this is what we learned on Tuesday, that we add back depreciation because it is a non-cash item. We reduce it just to include the depreciation tax shield. And then we multiply all these net cash flows with the present value factors of 12%. And we get 11,06,000. And then, mind you, there is a salvage value of the old new machine, 40,000, which also gets added here. And we compare these with the initial cash outflow. we compare this with the initial cash outflow of 8 lakhs, we get a positive NPV. So Dinesh, I hope it is clear now. We are getting a positive NPV, hence the machine can be replaced. Had this been a negative number, then we would have been probably suggesting continue with the existing machine. Make sense? Everyone? Let me know any thoughts, guys, till now. Great. So 3,28,000 positive, and we go ahead with that. Amazing, guys. Okay. So guys, I think you guys got this point that this is a very, very interesting question in terms of the machinery replacement one. And my suggestion would be that, okay, that you go with the incremental approach, because otherwise it could be a little tedious for you guys. If you see that, okay, what is, I'm sure, Dinesh, when you were asking why we are looking at incremental, probably the only other way out, Dinesh, is you can do this entire calculation for an existing scenario, do the entire calculation for a new scenario, and then see the difference. So I think probably doing that exercise twice, it's better that you take the differential at one go. Yes, Alok, the decision is same. The only thing is we are kind of focusing on what all has been changing till now. Amazing, guys. Okay, can we all quickly look at another question based on that, guys? Another question based on that? Quickly. Okay. So we are looking at HMR Limited. Considering replacing a manually operated old machine with a fully automatic new machine. The old machine had been fully depreciated for tax purpose, but has a book value of 2,40,000. Machine has begun causing the problem with breakdowns, and it cannot fetch more than 30,000 if sold in the market at present. Present value is 30,000, right? Now, it will have no realizable value after 10 years. The company has been offered 1 lakh for the old machine as a trade-in for the new machine. Amazing. If you want to go for a new machine, you will get a 1 lakh. So on the new machine, which has a price of 4,50,000. So this first paragraph becomes very interesting. That if you're scrapping it, it's 30,000, but we're kind of buying the new machine and getting this bargain as a trade exchange, then probably this will be 1 lakh reduction on the price of 4,50,000. Expected life of the new machine is 10 years with a salvage value of 35. Okay. Now, we're talking about further the company follows the straight line depreciation method. Thanks for that. I think WDV made our work a little heavier earlier. Written down value method depreciation at 7.5% is allowed taking, that is only the machine in the block of assets. So we are saying that company follows straight line depreciation method, but for tax purpose, we're saying WDV. So that means probably the tax sheet will be still WDV basis. Okay. Okay. So we are talking about some expected sales given from old and new machine. What is changing, guys? Let us highlight. Sales remain same. Material cost going down. Labor cost also slightly being reduced. So is variable overhead. Fixed overhead is slightly increased here. Depreciation, of course, increase. Profit before tax, very good. It's an increase. And then we have a tax and the profit after tax. We have to analyze whether the old machine should be replaced or not if required rate of return is 10%. Amazing. Now, what will happen in this scenario, guys? If we were to compute something in terms of our thought process, what will be my basis for depreciation, first of all? Or the cost of the new machine? Everyone agreeing that it's 4,50,000 minus 1 lakh? 3,50,000. You guys agree with me? This will be the cost of the new machine, guys. Anyways. All okay with that? Also, we are looking at a profit before tax of 324 and 387 given to us. Now, if that is the case, what will be the profit before tax and depreciation, guys? What will be the profit before tax and depreciation? Can we add this up? They've given the profit before tax. Can we add these up? We'll get a 348,750, which is increased to 428,750. So before depreciation, profit before depreciation and tax, it's a 80,000 jump. Making sense to everyone? Because depreciation, we anyways will be doing the incremental depreciation anyhow. We have to do that. Like, unfortunately, even though they are following the straight line method, but okay, and you can, why we are doing this? The question is why we are doing this? Because this depreciation is, thank God, is a straight line method, but unfortunately for tax purposes, they mentioned later on, no, it is WDV only. And how come they have given 41,500? 4,50,000 minus 35 upon 10 years life. So that 41,500 was a straight line method. But for tax purposes, I have to calculate the depreciation as per the written down value. Everyone okay, guys, till now? I think what I'm heading towards is, basically, I'm heading towards calculation of incremental cash flows of this 80,000, and we will adjust it with depreciation. Then we'll calculate the present value and compare with 3,50,000. That is what we are heading to. Everyone okay with this 2 points, guys? 2 points, what I'm saying is, my initial net cash outflow is 350. And second, my incremental profit before depreciation and taxes, 80,000. So I'm assuming this point is clear to everyone. We are adding the SLM depreciation here. Now, once we are all aligned till this stage, we take all the 10 years and we start calculating the depreciation based on the WDV. How much value this 7.5% is calculated on? 3,50,000, I guess. 3,50,000 into 7.5% is 26 feet, T should 250. And accordingly, it will get reduced because it's a WDV. Alok, we are heading to comparing the incremental cash flows present value with 3,50,000. So what I'm doing is 80,000 minus depreciation gives you profit before tax. Then you reduce the tax and then add back the depreciation here. Add back the depreciation. And we multiply these amounts with the respective present value factors for 10%. And at the end of the 10 years, there is a 35,000 salvage also. So basically, the present value of incremental cash inflows is 3,94,000 and the net outflow was 3,50,000. Hence, we again get a positive number here. Answer remains the same. The machinery should be replaced here. But I want to give you guys a couple of minutes to digest it. Let me know if you have any doubts, guys. I'm waiting for your queries on the screen. Okay. Geet has a very interesting question. Why did it not do 450 minus 100 minus salvage value for a depreciation? Very interesting question, Geet. Anyone would like to answer that? I would like to cross question this to everyone. Geet, anyways, did we do that in the last question also? Can you double check? I doubt. I don't think we did consider that. I think answer is very simple, guys. Geet, just a small point. A very good question, but a small point. I can answer your question with response to a question redirected to you. Do you consider salvage value in the case of WDV? Geet, question is, do you consider the salvage value in case of WDV? I hope you got your answer. Good observation. But I think for some moment, we forgot something which we were taught earlier. Amazing, guys. I'm sure people are active here. Geet, absolutely wonderful. Okay. Sofal says, is there any significance of the line for tax purposes that has been fully depreciated? Again, if again, Sofal, it were to be a block of asset scenario, or if there were to be a gain or loss, then we would have considered it. Like scrapping it for 35,000 now, right? But we are not scrapping it. Sorry, not 35, but how much was that value? I guess 30,000, right? So if you're like scrapping it, was fetching just 30,000. That's it. Dinesh says, why depreciation is not added back after tax? Dinesh, can you double check? I think it should have been added 53,750 minus 16,125 plus 26,250. It's added, Dinesh. Can you check the top formula on the top? The column 6 is equal to 4 minus 5 plus 3. And third column is depreciation. Dinesh, I hope it is clear. Alok, I hope you also got the point. Guys, anyone else? Any questions? Great. Okay, let's quickly recapitulate of what all we have done on one slide, guys. We discussed non-discounted techniques, payback, accounting rate of return. We have a decision in terms of mutually exclusive projects, lease payback, in terms of ARR, maximum ARR. We talk about NPV, highest NPV with the capital rationing is an exception we discussed today. Profitability index. If NPV same, a higher PI will be selected. IRR, again, the maximum IRR to be selected, and I correlated how IRR is kind of compared with WACC for exception or rejection of a project. So it's time for a couple of brain teasers for everyone, guys. And I request you guys to answer it with the question number. So answer starting in for flow for the question number 1, guys. I hope you guys remember my discussion in terms of the working capital. There were 3 possibilities. it was either increase in working capital initially and release at the end, or reduction in initial and reinstatement at the end. The language here is a release of working capital at the end. That means initially it was invested, right? That means initially it was an additional working capital, would have an outflow. Hence, at the end, it would be option number A, that is cash inflow, guys. Had it been a reinstatement, guys, the word is reinstatement, then it would have been an outflow because it would have been more of an automation project. Good job, guys. So 1A. But I see a little different answers getting in for question number 2, guys. Be careful. Giving 30 seconds more to everyone. Till now, question number 2 has been given like A, B, and C. Like all the 3 options are given by the students. No one has selected D, right? Yes, please. We discussed this towards the end of the last class about when does the multiple IRR situation happens, right? Multiple IRRs. We remember when I told that generally in a project you have an initial outflow and then you have inflows. But what if in a project there are outflows, inflows, then again outflows and then inflows? Then you could have multiple IRRs. We also call it as cash flows reverse their signs during the project because you have inflows after outflows and again inflows and so on. But when those of you selected A, cash flows in the early stages exceed cash flows in the later stages, that is not for multiple IRRs, but that scenario is for the cases where IRR favors these kind of projects. And I think C is nothing to do with it. So guys, I would not even go for C. So yeah, so basically, so Geet, I think I could see your reasoning, but Geet, for the same reason, it cannot be a multiple IRR, right? Multiple IRR cannot be the scenario for C. Guys, everyone okay here? A refers to those cases which IRR favors. B is the scenario where it could be more than one IRR because it results in, let's say, a question in year 1 there is an year 0 there is an outflow. Year 1, 2, 3 inflow, year 4 again inflow and outflow, and then again inflow. So it's like multiple outflows. And for that, probably we discussed one approach. Does anyone remember? To cover that up? Modified IRR, if I'm not wrong. We compounded all those cash flows towards the end, except for initial outflow. I hope you remember. So I can guess that. I think probably most of you were like confused in this option. I think that relates to the concept we discussed in the last 10 minutes of the last lecture. But I hope now everyone is clear. Great, guys. Good. Absolutely wonderful. Okay. So let's do one thing, guys. On the other side, we have a lot of practice here. So I have a comprehensive question in this. But this question is very easy, guys. This question barely involves a lot of calculation. Gamma company, which is given 4 projects, cash outflow, cash inflow, multiple years, like project A is for 1 year, project B is for 2 years, project C and D is for 3 years. And we have to calculate payback, ARR, IRR, NPV. So this question I am giving you guys for homework. You have answers also, and I will upload one more PPT after today's lecture, probably by tomorrow, which have solutions for all the questions. I will upload that PDF also. And I request you guys to do those questions which we are not covering in the class. So there are a couple of questions which I'm planning to give as a homework. So one is this comprehensive. This is very straightforward. I do not want to take it here because this is just calculation. There is no complication. There is no tricky element involved. But having said that, after this question, we have some practice questions, almost 6 to 7. So let's take a 10 minutes break here at 7:15. Once we come, the remaining gets your assignment, and you will get the answers probably by end of the day tomorrow, so that you guys can compare your answers with these questions, guys. So Let's take a 10-minute break here. Once we are back, we will be doing a lot of practice in the later half of 1 hour. See you guys on the other side of the break. 10 minutes, please. Okay, folks. So I hope everyone is back from the break. We had a lot of energy in the first half, and what we intend now is to cover some practice, implement what we have learned, right? So let's unlock our concepts with the unlock limited practical question, which is the first one on your screen. So let's see what exactly is all about. Let's go through the question first, and probably we'll walk through together. So Unlock Limited wants to replace its old machine. And I think many of you might be thinking that this machinery is not leaving us today, right? Replacing its old machine with a new automatic machine. Two models, A and B, are available at the same cost of 5 lakhs each. Now, in this context, the salvage value of the old machine is 1 lakh. Utilities of the existing machine can be used if the company purchases A. Very good. And the additional cost of utilities to be purchased in that case is 1 lakh. If they were to purchase machinery B, and all the existing utilities will have to be replaced with new utilities costing 2 lakhs. Salvage value of the old utilities is 20,000 or 0.2 lakhs. And they've given us the cash inflows for both machine A and B. And they've given us the target return on capital of 15%. We have to calculate the NPV of the two machines separately. I think, Dinesh, you were missing this kind of a question, that we are not kind of looking anything incremental here. We are just comparing these two machines, right? So we are talking about, okay, we need to calculate the two machines NPV, discounted payback, desirability factor or profitability index, and we have to advise which one to be selected. So it's like a slightly different approach from what we discussed earlier. It was like whether we need to continue with the existing machine or replace the machine. That was the scenario. In this case, what we are looking at is that we have decided to replace the old machine, but we need to probably choose between machine A or machine B. Now, I want to ask you guys a question here. What would be my initial outflow for machine A and machine B? I want your answers with A and B here, please. I'm looking at the query panel. I want your answers. What will be my outflows, guys? In case of machine A, in case of machine B. You can say A, so much amount, B, so much amount. Okay, let's see what other responses here. Jyoti says A 4 lakhs, B 3 lakhs. Amazing. Piyush says A 5, B 7. Amazing. Guys, think over. I'm sure if I'm asking you guys, and you might need to act like ACP Pradyuman, right? Kuch to gadbad hai, something like that, right? Something is fishy. Sufal, I'm very glad you are very close, actually, my friend. But you missed a small thing. Vishwaja says A 6 lakhs, B 7 lakhs. Geet says, okay. Geet, I think you are also very close. I think the most closest answers I'm getting is from Geet and Sufal. Okay, I think everyone else, Prem, Alok, Pranav, I can see your answers, guys. Let me talk about this. Now, what's happening in this case is, guys, if you're talking about machine A, guys, one thing is for sure, both the machines are costing 5 lakhs. And the salvage value of the existing machine is 1 lakh. That is for sure. So that means at the end, if we ignore the utilities part, we are anyways investing 4 lakhs for both the machines. Ankit, awesome. Dinesh, very good. So I think now I'm getting some accurate answers. Now, if we are talking about 4 lakhs is an outflow for both the machines, but now we not need to include utilities. For A, the existing utilities could be used and the additional cost of the new utilities were 1 lakh. So for A, it becomes 5 lakhs. For machine B, you have to incur 2 lakhs, but the existing utilities can be scrapped for 20,000. So 4 plus 2 lakhs is 6, minus 20,000 is 5.8 lakhs, guys. So correct answer is 5 lakhs and 5.8 lakhs. Everyone okay with that? I think that is the only trick involved in this question. Trust me, nothing else. If you get to know what we are saying here, I think the rest is pretty much on the screen. It's the initial cash outflow that you need to understand, because see, they've already given you cash inflows. You have to just discount and calculate the present values. Rest is history. I can imagine that rest of the stuff you guys know it very well. Okay, so guys, everyone okay here? 5 lakhs, 5.8 lakhs, all okay with machine A and machine B? No, Geet, it was not for mutual. It is when you are replacing with the new utilities. I anyways got your interpretation when I looked at your answer. Okay, so guys, everything else is a mathematics here. If you guys can see, let's walk through this together. 5 lakhs and 5 lakhs 80,000 is what we all agreed upon just now. And then everything else is kind of calculating the present value in terms of these numbers. 1 lakhs, 150, 180, 2 lakhs, 170 and salvage value. And that's what we are looking at. In the 5th year, I have included 220 and 1 lakhs by including the salvage value here. I hope everyone is fine here. Jyoti says, can you repeat? Prachi says, please explain again. Okay. Manoj says 5 minus 1 plus 1. Yes, Manoj, absolutely correct. But I think, yeah, I think that's fine. 5 minus 1 is 4 plus 2, absolutely correct. So some people wanted me to explain again. Guys, for both machine A and B, both were costing 5 lakhs. Salvage value of the old machine is 1 lakh. So 5 minus 4 lakhs is the investment in the new machine anyways, whether it is A or B. But for A, the existing utilities can be used and additional utilities are required for 1 lakh. For B, existing utilities cannot be used. The new utilities need to be purchased for 2 lakhs and the existing one can be scrapped for 20,000. So additional 1.8 is required for B. Additional 1 is required for A. So that's why 5 lakhs and 5 lakh 80,000. Prachi, makes sense? Jyoti, what about you? And Ankit, Manoj, Ganesh, very good. I think you guys are spot on. I hope all the queries are resolved now. Whosoever asked me on the query panel, everyone is on the same page. So guys, now what I've done is, if you see the next slide, we have included the salvage value with the 5th year cash flows, that is 220 and 1 lakhs. I hope everyone is okay with that. This kind of eases out our calculation in terms of multiplying with these present value factors. So present value factors are given to us for 15% and we calculate the present value for A is 43,800 and for B is 19,300. So that is my NPV. With these NPVs, which is the project or which is the machine I select? Obviously machine A. With the payback or a discounted payback, I'm getting like a slightly, very slightly, a lesser time frame by 0.01 for machine A. Although it's like very negligible, but still if we have to select one, we could select machine A. And same is the result with profitability index. Now profitability index is kind of how we are calculating the profitability index, guys. We can probably see a present value of cash inflows is in terms of a cumulative number. We calculated a 543,800 divided by 5 lakhs. That's a 1.09. From where I am taking this number, guys? We calculated the cumulative present value divided by 5 lakhs, 1.09. And then we have 5,99,300 divided by 5,80,000. You're getting a 1.03. So definitely profitability index, the payback method, net present value, all the three indicate machine A, guys. Everyone okay here? Any doubts so far? Machine A preferred by all the three? Great. So no question so far. So we can move to the next practical question, guys. Okay, so the next question is one of my own favorites one, and I want like everyone to be very careful here. Ironically, this is kind of not testing you on too much of a present value scenarios, but this question will test you in terms of your analytical skills, right? This question pertains to not Bajrangi Bhaijan, but we are looking at a Bajrangi Chimney company here. So Bajrangi Chimney company evaluating three different investment situations. One, produce a new line of aluminum chimneys here. Two, expand its existing line to include the several new variants. That's the second project. And third is developing a new higher quality line of exhaust. Wow, we're moving from chimney to exhaust. For me, the interesting line starts now. If only one project is undertaken, then its standalone expected present value and the amount of investment is here below for all the three projects. If only one project is undertaken, its standalone expected present value and amount of investment is given below. We're talking about one project at a time. Investment one, project one, investment 2 lakhs, present value of future cash flows 290. Similarly, we are looking at 115 and 185. We can actually note down a present value or a NPV simultaneously here. If one project were to be taken, this is 90,000, this is 70,000, and this is 1,30,000. You may say that, okay, go ahead with the project 3. You may say go ahead with the project 3, but the game is not yet over, guys. Game has just started. Game has just begun. Look at the rest of the information. If projects, I'm looking at the right side of the table here. If projects 1 and 2 are jointly undertaken, there will be no savings, guys. Investments required and present values will be simply the totals. So if projects 1 and 2 were taken together, what will be my NPV? That means if 1 and 2 were taken together, NPV, if my 1 and 2 are taken together, would be just similar total of the two NPVs, 1,60,000, guys. Make sense to all of you? Because they're saying that there is no savings here. Investments required and the present values will be just subtotals. That is, investment required will be 315 and the present value of future cash flows will be 475. 475 minus 315 is 160. Guys, I hope everyone is going good here. With projects 1 and 3 in question, now we are not looking at 1, 2, 3 individually. We are not looking at 1 and 2. We are looking at 1 and 3. With projects 1 and 3, economies are possible in investment because one machine acquired can be used in both production processes. And the total investment required for 1 and 3 is 4,40,000 guys. Amazing. So guys, if I have to do 1 and 3, what is my normal NPV? 220. Normal NPV is 220 anyways. But with this economy, my total investment is 440 given to me instead of 430, right? 470 rather, right? Instead of 470, I'm incurring 440. How did I get 470 guys? 2 lakhs plus 2 lakh 70 is 470. But they're giving us 440. That means their increase in NPV by 30,000. Am I correct? My NPV will be actually 250. If you know, probably if you guys can correct me if there is some issue here. Everyone with me on this? 1 and 3, 250. 220 was normal, 90 plus 130. But with this savings in investment, my investment was 2 lakhs plus 2 lakh 70,000, 470. But since one machine could be used in both the projects, it is 440. So 30,000 NPV will increase because my outflow is reduced. It will be like 690 minus 440. Other way around to look at it. 6.9 minus 4.5, 4.4. So we're giving you a 2.5 lakhs. All okay, guys? With 1 and 3. Till now, where do we stand, guys? Till now, where do we stand? Which combination is giving us the maximum NPV till now? Project 1 only 90,000. Project 2 only 70. Project 3 only 1,30,000. Project 1 and 2 1,60,000. And project 1 and 3 2,50,000. So that means till now, this is a very, very good combination, 1 and 3. But we have yet a distance to follow. Okay. Now let's move on. If projects 2 and 3 are undertaken, we're looking at 2 and 3. There are economies to be achieved in marketing and producing products, but not in investment. Oh gosh. Investment remains 385, right? To 115 plus 270. But the expected present value of future cash flows shall be 6,20,000. Amazing. Right now, I can see 2 and 3 is giving me 585 and they're saying 620, right? So if you'll see project 2 and 3, what is my normal NPV, guys? 70,000 plus 1,30,000, 2 lakhs. 70,000 plus 1,30,000, 2 lakhs. And then we are saying that instead of 5,85,000, we are getting 6,25,000. So what is the additional increase in inflows, guys? 585 to 620, I think additional 35. So my NPV remains 2,35,000. We can also compare like 6.2 minus 3.85. All going good? With this thought process, I think 1 and 3, the earlier combination is still better, right? Because that was NPV of 250. We are getting 2,35,000. I'm giving everyone 1 minute to digest it, guys. Anyone having any questions, let me know. I hope everyone okay. Once you confirm, we can probably move ahead to the last leg of the question here. Okay. Now, the last leg of the question is, if all the 3 projects are undertaken simultaneously, Alok, you're very, very optimistic. I'm amazing. There will be a couple of questions we'll be taking some time. So don't worry. I intentionally would like to give you at least 2 or 3 questions as homework. Don't worry. Okay, so Alok was saying that we might complete all the questions there. I will try as much, but yeah, I will personally prefer some questions to be as a homework, right? Of course, you have past year papers to practice anyways. Okay, so if all the three projects are undertaken simultaneously, okay, now there is a question coming in from Varsha. Varsha says from where 6.2K? Varsha, 6.2 is given in the question. Expected present value of future cash flow for project 2 and 3 is 6.2, 6,20,000. Varsha, this is given in the question itself. So instead of 585, we are looking at 6.2. Okay, great. Now, if all the three projects are undertaken simultaneously, they're saying economies noted will still hold. Amazing. I'm so happy, you know. They're saying like, okay, if 1, 2, and 3, I'm writing on the top, the economies holded will still hold, but there will be an additional 1,25,000 extension required here. Amazing. They're saying that economy is okay, but we would like to get some additional investment. So if economies will still hold, what will be my present value of inflows, guys? 6,20,000 for 2 and 3. And project 1, there was no economy. So 2,90,000. So 6,20,000 plus 290. That means 9,10,000. 9,10,000. If you're taking 1, 2, and 3 all together. And what will be the outflows? I think 1 and 3 have 4.4 given to us, because the word is economies noted will still apply, will still hold. 4.4 for 1 and 3 and 1.15 for project 2, 1.15 for project 2, if I'm not wrong. $6.8 if I'm not wrong. And if that is the case, my NPV is 2,30,000. Now, if had this additional investment not required, this would have been a winner, right? Had this additional investment of 1,25,000 not required, a combination of projects would have been best, right? And look at that, where we started from today is like capital rationing. Like here also the capacity was rationed and we had to increase the capacity by investing another 1,25,000. So guys, what combination looks best here? All the projects 2 and 3, 1 and 3, or individually? I think 1 and 3 still wins the race. 1 and 3 still wins the race, guys. Can anyone agree, disagree with me on the query panel? Any questions so far, guys? Okay, Alok says, please repeat the last part. Alok, if all the projects are undertaken, the question says that economies noted will still hold, right? There were two economies we mentioned earlier. But as far as outflow were concerned, there was some economy in 1 and 3. Instead of 470, it was 440. And as far as inflow is concerned, there was economy in 2 and 3. Instead of 585, we have 620. So we have noted down that economy. So inflow is 620 plus 290. That is 910. Outflow is 440 plus 115 of project 2. Outflow was this only. However, in the question, there is an additional 1,25,000 mentioned. So we had to increase our outflow from 5.55 to 6.8. Alok, makes sense? Prachi, so would you go for project 1 or 1 and 3 both? I think 1 and 3 both, right? Project 1 is giving you only 90,000. So 1 and 3 would be a good option. Guys, whatever we have done, you can see now on the screen. Whatever we discussed, you can now see on the screen here. You can see the last column, and I think I've actually intentionally done some kind of a color shading to highlight the economies, guys. If you see the green color here, this is highlighting the investment economies, and blue is of course the economy in inflows, and the yellow one is the maximum NPV we have. So I think it's a very, very good question. I'm sure you guys agree with me that it's not asking you a lot of calculation. It's not technical in terms of calculation, but it is definitely testing your analytical skills. And on what basis you guys can analyze and make a decision like a financial manager. Guys, make sense to everyone? Okay. So let's move to the next question then. Give me a second. Okay, I'm moving to another question, which is on the screen. This is General Manager of Mary Limited. I hope everyone can see that question here. Great. So what is happening in this one, guys? They're considering replacement of a 5-year-old equipment. The company has to incur excessive maintenance cost of the equipment. The equipment has zero written down value. It can be modernized at a cost of 1,40,000, enhancing its economic life to 5 years. The equipment could be sold for 30,000 after 5 years. Modernization could help in material handling and reducing the labor, maintenance, and repair cost. Now, I want to show you this question that, what exactly we have done today. Quite similar stuff, right? They're saying that a company has another alternative to buy a new machine at a cost of 3,50,000. The new machine is expected to be more efficient in reducing the cost of material handling, labor, maintenance, and repairs. And they're giving you the annual cost of all the three situations, whether you want to continue with the existing equipment or you want to kind of go for a modernization or you want to go for a purchase of a new machine. Now, that means probably it's a kind of a, not exactly a replacement, but replacement by how, right? Replacement by doing just a modernization here, or probably just replacing it with a new machinery, right? So are we kind of just modernizing or are we just replacing with a new machine here as well? So I want your input, guys. If you're looking at this particular question, what would be your approach, guys? What would be the first step? What would be your first step, guys? Anyone wants to answer in the query panel? I think first step would be the cash outflows in both the scenarios, modernization and new machine. Right, so modernization is involving 1,40,000, and a new machine is costing you 3,50,000. Am I correct? This should be your first thing, initial cash outflows, both the scenarios. Now, if you are aware, okay, this 140 is something you have, we need to understand what is the additional or the difference in the annual cost. Now, what we will do is, guys, I think an ideal scenario, because we are looking at replacement either via modernization or machine, and we are focusing on incremental, we will first compare 45 and 35,500. Let's say for wages, what is the savings? And we will compare for new machine 45 to 15. That means if I have to say let's say a modernization or a new, I'm comparing this versus existing. So can we say savings versus existing? That means in the case of wages, it is 9,500, 30,000. Here it is 10,000, 13,000. Maintenance has gone down from 25 to 5, 20,000, 22,500, I guess. And same here, 30 to 20, 10, and 15, guys. I think you guys can probably double check your answers. What is this? 49,500. Till now, everyone okay, guys? I'm just doing a comparison of what is the existing scenarios in terms of the cost and what is the new one. But in both the cases, if these are the savings, what about depreciation, guys? Can you give me the depreciation for both the scenarios, modernization and new machine? Because see, we will have to see this net of tax, right? We'll have to see net of tax. So what is the modernization depreciation will be? Waiting for your answers in the query panel. What will be the depreciation, guys? Mind you, in the present scenario, what is happening here? If you're modernizing it, we are incurring it at a cost of 140. And if you're incurring the cost of 140, we will be having a salvage value of 30,000 as well. Can we say 140 minus 30, 110 divided by 5? So my depreciation will be 140 minus 30,000 divided by 5, 22,000, guys. Whereas in the new machine, it will be 3,50,000 minus 60 divided by 5. That is 590 divided by 5 is 58. So Geet, Sufal, Dinesh, Prachi, good answers, guys. Prachi, but I think you need to just double check. I think reduce the salvage value for the modernization as well. Jyoti, very good, guys. So 49,500 is the savings, 80,500 savings. What we'll do is we will reduce the depreciation, then we will apply tax element and add back the depreciation. So whatever we have discussed till now, let us implement that. I think we were all till this point okay. 49,500 and 80,500. We get total savings after depreciation. Then tax is reduced at 50% given to us. And we are adding the depreciation after tax shield. So what we are getting is incremental annual cash flows 35,750 and 69,250. We had to calculate depreciation to give the tax, tax shield over there. What could have been the other method, guys? Anyone remembers that? Modernization and new machine. Other method, does anyone remember? 49,500, 80,500. If we straight away probably go for a tax here, 24,750. 40,250. If I ignore the depreciation altogether, we get 24,750 and 40,250. And then we add the tax shield or depreciation. Tax shield on depreciation. So let's say for a modernization, my depreciation is 22. Tax shield will be 11,000. So I'm again getting 35,750. So it's a method 2. I discussed 2 methods on Tuesday, right? Similarly, here it's 58,000 into 50%, 29,000. So we get the same results with our method 2 also. Just a quick recapture of what we did on Tuesday. Alok, wonderful. Sofal says we could have compared modernization and new machine. Sofal, yes, I agree with you. I absolutely agree with you. That could be an alternative approach. I'm just doing it just to maintain a standardization here. And I think your suggestion in this case could have worked because the subtraction would be same, right? The existing machine would be same. The only thing is, think from that perspective, Sufal, that the depreciation on the modernization, we are only calculating on the incremental stuff. So the point is, how would you have considered in terms of the salvage value and all, right? So I think let's stick to a standard approach. Otherwise, we'll create a confusion for ourselves. Guys, everyone okay here? I think you were not able to see the method 2. Now you can see it. I've just mentioned method 2 on the screen. Any doubt so far? And if you're understanding it, then what would be my last step? What would be my last step, guys? Probably last step would be to go for discounting. We talk about discounting these cash flows. 35,750 and 69,250 we discounted. We also add the salvage value, present value, and we get a net present value which is negative for a new machine, but for modernization it's a positive one. That means we are looking for advice on modernization for this company and not for purchasing a new machine. I hope this one is also clear to all of you. Okay, great. So I think I can see a perfect response from everyone saying that it is all clear. Remember that all clear is of 2 types. All clear means it's all over the head, and another all clear means it's going in the head. So I hope this is the proper all clear. Great. So guys, I think let's move on to another practical question then. As I promised, we'll do a lot of practice. Let's look at this question now. City clap. Okay, so what do we have here? In this company, City Clap is the business of providing housekeeping services. There is a proposal before the company to purchase a mechanized cleaning system for a sum of 40 lakhs. The present system of the company is to use. Okay, interesting question from Muhammad is solving with sir is easy, but solving after the class is not so easy. So Muhammad, you have touched the pain area for many students, right? Since we were kids in the school, it always remained wonderful, right? When we are showing a question in the class. Again, Mohammed, the answer is try to concentrate when you're solving at home. And trust me, if you're doing some mistake, my problem is that, like not really if you're doing a mistake, my problem is that if after doing a mistake, you're not realizing where do you go wrong. If you understand where you went wrong, I think you are good, right? You will try to avoid that mistake in future, right? That's what I can say. I think practice is the only key. Remember, there are only 3 ways, or rather 3 key points to success. I hope you guys remember the three techniques I tell you, right? Anyone remembers from cost of capital? three techniques to succeed: practice, practice, and practice. So there is no additional one, only practice. Anyways, so coming back, guys, to this question. So city clap, right? So there is a proposal to purchase a mechanized cleaning system for 40 lakhs. The present system of the company is to use manual labor for cleaning the job. That's very tedious. You are provided with following information: proposed mechanized system here, cost of machine 40 lakhs, life of the machine is 7 years, depreciation on straight line after a long time. We are like looking at straight line. This is, I hope this remains the same though, 15%. Operating cost of a mechanized system is 20 lakhs per annum. Then we're looking at a manual system which is existing is a manual labor 350%, 15,000 per person per annum cost of manual labor. Companies an after tax cost of under 10%. Applicable tax rate is 50%. Okay, they're given the present value factors also, and you're required to determine whether it is advisable to purchase the mechanized system or not. I think typical capital budgeting question, right? So what to be done here? What do you think, guys? We have to compare both, probably. We can compare the both, as in my starting point, as always, would be the same, but I want to hear from you guys. What should be your starting point here? What is the framework you are building in the mind that how should we approach this question? The decision point for us is whether to purchase the mechanized cleaning system. And I would say compare the cost versus savings. Alok says find the outflow first. Great. So I think in Alok, we are lucky that outflow is given, right? 40 lakhs. 40 lakhs is what we have. But we have to compare the cost, right? What is the cost here? What is the present cost, first of all? My present cost is 350 into 15,000. How much is that, guys? We're getting a 52 lakhs 50,000, I guess. That's the present cost. And what is the new cost here? 20 lakhs. Any other cost? Any other cost, guys? I think depreciation, because it's an automatic one, like automated scenario. And we will anyways have to see a tax shield on the depreciation. We can do that also. Let's do that. So if you're looking at 20 lakhs, my tax shield or depreciation is how much, guys? Anyone? Okay, what I'm trying to say here is that my present cost is 52 lakh 50,000. My new cost is 20 lakhs, 32 lakh 50,000. There is a tax element of 50%, 16 lakh 25,000 tax. We're getting a 16 lakh 25,000 as a net saving. But where is depreciation? Can we add a tax shield of depreciation, guys? 40 lakhs into 15% is 6 lakhs. 6 lakhs plus 50%. So tax shield of depreciation is 6 lakhs into 50% is 3 lakhs. I think there is one additional zero. So let me just remove that. So are we getting 19 lakh 25,000, guys? Everyone? I am getting 19,25,000. I don't know about you guys. So what we need to do is we have to calculate the present value of this 19,25,000. This is for how many years? 7 years, right? So we need to have a present value annuity factor. Add all these factors. Add all these factors multiplied by 19,25,000 and compare it with cost. I think with the naked eye, it seems that we are good to go, right? With the naked eye, because cost is 40 lakhs, 19,25,000 is just for 1 year, right? It's just for 1 year, and we're looking for 7 years. Even we discount, it should be more than 40, I guess. So guys, we're looking at one, or rather the factors given to us, 0.909 plus 0.826. I told you the another way of calculator route. We could do 1 divided by 1.07 m plus equal to m plus equal to m plus 7 times. I hope you remember that. If you do 7 times, you can kind of get that in a split of a second. No, this is not 7, this is 10%, right? So 1 divided by 1.1, 7 times. I think I'm getting 4.868 if you guys are getting the same. Or 867, whatever. 4.868, 4.867. If we add these factors up given to us, it's 4.867, I guess. So you multiply this with 19,25,000. And I'm getting a handsome 93 lakhs, 68, 90, 975. And we have to just reduce the present cost of 40 lakhs. Amazing. It's too much, right? It's too much, way positive. I think there is no doubt that you should definitely, don't worry about the rounding of, guys. Don't worry about the rounding of. I can see different numbers coming in, but I think as long as your answer is around 53 lakhs, looks good. I think everyone looks good here. It's definitely good to go. I think automation anyways is always good. Okay, so guys, any questions on this one? Any questions so far? Great. Amazing, guys. Very good. So let's now move to maybe one more question we can do. So let us quickly go to another question here. Okay, give me 1 second, guys. Okay. So let us talk about a question which is on the screen right now, A&R Limited. Now, in this question, we're looking at a company has taken a project which has an initial investment of 2,000 lakhs in plant and machinery and 800 lakhs for working capital. The plant and machinery would have a salvage value of 474.61 lakhs at the end of the 5th year. So plant and machinery would depreciate 25% on a WDV. The other details are given as below. Sales, selling price, variable cost, fixed overheads, corporate tax rate, rate of interest, after tax required rate of return. So they have given us the present value factor for 12% and 15%. Amazing. Calculate the NPV of the project and determine the viability of the project here. And then we are discussing the sensitivity of the project also. Amazing. So how do we go about this, guys? Any thoughts? How do we go about this particular question? See, in the first scenario, we are just talking about as is. Okay, Alok says that there was an answer sheet where answer is rounded off, note was given. I don't know, Alok, where exactly you have seen that. I'm not sure whether you are actually looking at an ICI answer sheet, because this generally cannot be the case. First of all, rounding off instructions would be there. If they are not, if you're kind of making your assumptions and noting that, no one will deduct your marks, don't worry. Mohammed, that's the spirit. Okay. So Geet says calculate cash flow after tax. Okay, great. So guys, first we have to calculate the existing scenario NPV, and then we can see there is a sensitivity analysis also given to us, right? So how do we go about this, guys? Both the scenarios. Calculate the NPV. So what should we do? Let's do one thing. We are calculating the NPV as in terms of what we have already done. In this particular question, let us understand what is that which is differentiating this question from other points. Selling price. So we do a selling price minus variable cost. We have a fixed overheads excluding depreciation. So probably if I'm looking at 500 minus 250 is my contribution. 250 into 10 lakhs. So even if we talk about in lakhs, number in lakhs, you can accordingly make a calculation. So we are getting almost 2500 lakhs, right? If I'm not wrong, 250 into number of units. That's my contribution. Minus fixed cost is 300 lakhs. So we are probably getting a profit. And then after tax, we can just do a comparison of a depreciation tax shield as well. Now, we can compare the net book value with the initial investment and the working capital along with that, and compare the NPV. I would actually not talk about the calculation part. You guys can manage on your own. I would like to actually talk about point number 2 here. Determine the sensitivity of the project's NPV under each of the following conditions. Decrease in the selling price by 10% and increase in the cost of plant and machinery by 10%. What do you think, guys? Decrease in selling price by 10% and increase in the cost of plant and machinery by 10%. So what's happening here is, if we are looking at decrease in the selling price, the interesting factor is they're only talking about decrease in the selling price by 10%. And they are not talking about a variable cost. Variable cost was 50% of the selling price, which was 500, which is 250 here. But are they talking about variable cost saving? Really not. Guys, are you getting me? In this case, they're just saying that selling price has to be reduced. They're not even talking about the variable cost. So if they're not talking about the variable cost, you need to keep the variable cost as same as 250. Are you getting it, guys? So let me show you what I'm trying to say here. Is that sales volume remains same, 10 lakhs for all the years. Selling price has gone down. Variable cost remains same, 250. Contribution, of course, goes down, right? 200. And the total contribution is 2000 for all the years. Fixed cost remains the same. And then we are talking about depreciation, tax saving. In terms of depreciation, we know that we are looking at the 25% on WDV. So 2000 is my investment value. So depreciation is on the WDV 500, 2000 to 25%, then 1500 to 25%, and so on. Alok, this is exactly what I was explaining, right? They are mentioning in the basic format of the question that variable cost is 50% of the selling price. But when they're changing something, they're not changing the variable cost. Okay. Pranav says, sir, it is variable. It should be changed according to the sale. Pranav, I think you have a very different question altogether. We are talking about variable cost per unit. Variable cost will per unit generally remains same unless they have specifically told us. But variable cost and totality change, right? I think Pranav, you got confused for a moment. Variable cost change in totality. So we will be changing the variable cost, but we are not changing per unit variable cost because the question doesn't say so. So Sufal, because they have not changed the variable cost in the question. Again, this is a classic scenario, guys. If you are stuck in such kind of a situation in the exam, I would definitely recommend to mention a note over there as an assumption, what you have taken. But I would say safer would be that if they're not given you anything, right? They have not talked about any. See, okay, let me answer this question in a different way. A lot of you are asking the same question. What if the option number A said decrease in selling price by 10% with a similar savings in variable cost also? Then it would have been a very easy one, right? You would have said, okay, 500 minus 10%, and similar would be in the variable cost. Make sense to everyone? But they have not mentioned that. They said only selling price is changing. Are you getting me? The question could have been other way worded around as well. I think rest is the calculation, rest is history. I want you guys to just understand what is the sensitivity analysis here. In terms of the sensitivity analysis, we're saying that what is happening to your NPV. Now, NPV, of course, in this terms, we're looking at adding back the depreciation. Depreciation is added back at this stage. And we're just kind of calculating the present value of all these cash flows. Mind you, a very, very important aspect. And the important aspect is for the terminal cash flows. I see terminal cash flows is total of all these. Profit after tax, add back depreciation, but also salvage value and the release of working capital. That is also added here. I think many times you forget the working capital in the last year. I'm sure those of you who are practicing at home might agree with me. This is a mistake you guys might have done in some questions, right? You forget the impact of the working capital towards the end. So make sure that you don't do that. Working capital needs to be taken care of at both the points, unless they give you some kind of an information specifically. Right? So present value factor, I think this is very straightforward. They gave you two rates, the bank loan and the after tax required rate of return. Of course, we will take 15%. We will take 15%, 12% could be a distractor. So we're saying 15%, discounting them up. And what we're getting is a positive NPV of 1920, which can be compared with the existing NPV, whatever you may compute it. Okay. Now, the other sensitivity analysis over there was, what if plant and machinery cost was increased by 10%, guys? What is the plant and machinery cost? 2,000. It becomes 2,200. Now that says it is increasing, your depreciation will change for sure. Depreciation for change. Depreciation is on plant and machinery, right? So your depreciation amount change, everything else remains the same, right? Everything else remains the same. And everything else was not 2,000 but 2,200. Probably if you remember what we discussed. In the present scenario, we had a 2,200 profit. 250 into 10 lakhs minus 300. So now we cannot compare A and like B after A, but A and B have to be independently evaluated because the question was under each of the following. So my existing profit before depreciation tax was 2,200. This was existing, not from A, guys. and then everything else is history here. You reduce the depreciation, you reduce the tax, you add back the depreciation, and everything is kind of pretty same. You add back the salvage value and the working capital in the terminal year, and then your present valuation factors is coming to be an NPV of a 2848, because hence what happened basically was you are increasing your initial outflows. You are increasing your initial outflow in the terms of the plant and machinery. Guys, everyone with me on this? Any questions so far? You guys can take care of sensitivity analysis, I believe. Prachi says, please repeat this point. So, Prachi, I'm just kind of telling you that A and B are taken independently here. In A, we are only changing the sale price. In B, we are only changing the fixed cost. And also in the B, the profit before depreciation tax is taken as per the existing scenario, which was 2,500 minus my cash fixed cost of 300. 300 lakhs is given to us. So 2,200 here. Varsha says, can't understand. Varsha, you need practice. Any specific query, Varsha, you can let me know, please. Okay, guys. I think let me just show you, there are few more questions here which I'm intentionally giving you for a homework. One is this Shiv Limited. Okay, this one we covered. And one is in the last. So question number 7. So I'm basically giving you a couple of questions as a homework, guys. Question number 4 and question number 7. I'm sure you guys will enjoy working around. And I will be uploading the solutions file. So I want you guys to work around these questions first, probably by end of tomorrow. So I will be uploading another file, which is the same file, guys. There is no change. It's just that it will have the solutions to most of these questions, which you may not have currently, because I want you guys to solve it on your own first. And then you can compare. Of course, you will learn. And I'm sure practice will make it more easier. It will not complicate things. I will say that, okay, practice all the questions. Piyush says that this chapter seems to be good in option. No, I think other way around. We will definitely look at from a perspective of that if you practice, this chapter could be your favorite also. I would definitely go for attempting this question. Okay. So I think that's enough from me, guys. Please try to practice, continue your hard work. And we will be probably meeting in a week or so time. I believe you guys can check the schedule. I think we are kind of meeting around on 26th next. We have 3 lectures on working capital management, and we will have a lot of fun over there. It's a very, very long unit. We'll talk about the receivables, cash and bank, payables, why working capital is important. So no, Manoj, we will be having 3 more sessions towards the end. Working capital, that will be very, very interesting. Pranav says, yes, Pranav, definitely. Sab golmaal hai, but after practice, it's all under control. That is my surety. Okay, so great, guys. I think pretty much perfect from my side. We are on time, and I thank you all for joining in. You guys were, as always, awesome with the two-way traffic, which I love the most. I love two-way traffic and my online lectures. I absolutely love it. It has to be a chaos with a full of queries, with a full of conversation. Of course, I don't like traffic on the road, though. No one likes that. So wish you all a good luck, guys. Keep on the good work. Make sure that you guys all have one thing in common. That's 24 hours. Make the best out of it. This investment of your time and efforts will definitely pay off in the future. So best of luck. Good night, all of you. We'll see you soon in a few days' time for working capital. Take care, guys. Cheers.